You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to The Investor Way with me, Sam Ball. It's the 20th of May, 2024, and I'm joined today by my co-host, John McEwen. And in this week's episode, we'll be discussing ABInbev, BP, BAE Systems, Airtel Africa, JD Wetherspoon, and our US company of the week is Disney. John, do you want to start us off with ABInbev?
Yes, so it's the world's largest brewer. We have covered it before. It owns brands like Beck's, Corona, Budweiser, Stella Artois, and many, many others in different regions. Anyway, they have their Q1 results out, with the group reporting first quarter revenue of $14.5 billion, up 2.6% on an organic basis. And that was in line with market expectations as 3.3% price hikes offset marginal decline in beer volumes. Underlying operating profit grew 5% to $3.6 billion, and improved profitability was helped by consumers' ongoing shift to more premium and profitable brands, as well as tight cost controls. Full-year cash profit EBITDA guidance has been reiterated, expecting growth to be between 4 and 8%, up 7% in 2023 for reference, which is in line with the group's medium-term target. And the shares were up nearly 6% following the results. I thought these results were actually pretty good. I think it's on a background of quite tricky times with the unfortunate adverts that they had in terms of Bud Light and the backlash that they received for those. But no, certainly not shoot the lights out. And I think when you look at the valuation, which is currently it currently has a market cap of 121.5 billion euros, and it trades at 17.5 times forward earnings. It is on the more expensive side. That being said, with the brands that it has in the portfolio, it's difficult to see it getting significantly cheaper, I would say. So I think fair, in summary, is how I would put it. Sam, what are your thoughts on these results from ABInbev?
I agree it's a tough market at present. I agree the brands they've got for lagers are pretty good. I don't know how much weight that carries. I'm not really much of a lager drinker, so I don't know how much loyalty there is. But I just think for these kinds of results, 17.5 forward PE with 2% yield, I just think seems quite expensive because I don't see where the growth's coming from. Unless, maybe it's going to be...
Yeah.
I don't know. I just don't see where the growth comes from.
I suppose if we were to compare it with a favourite of the show, Diageo, that does have Guinness, but it's predominantly spirits. I think that does better in the current market, even though people are shifting towards the more premium end of the beer market, just because volumes, I think, overall is more of seems to be more of a structural trend amongst younger people to be consuming far less in terms of volume. And I suppose if you've got that sort of backdrop, having that backdrop in spirits is much better because there's a greater margin and you can sell those higher quality spirits, even if you're not selling the volumes that you used to sell. So I think it wouldn't be my top choice. And I think Diageo, should we just have a look and see what that's trading at the moment? So Diageo, do you want to have a guess at what it's trading at, Sam?
25 times earnings?
18 times forward earnings.
I think it's a no-brainer which one you'd pick. I think as well, with Diageo, with it being more premium drinks, I think in developing countries, the brands are more aspirational. You've got countries with an emerging middle class. You'd want to be seen drinking sort of the Johnny Walker Black Label. No one's sat there trying to make their way up in the world thinking, I can't wait to be at a point where I can start buying Budweiser to impress people. It's just not that kind of brand. So I don't know.
Yeah.
I don't think it would translate as well to developing markets.
Yeah. And I suppose the other thing is also that it does have a fair bit of debt, which is net debt sitting around 3.4 times cash profit at the year end. And they're obviously targeting much lower, they're targeting two times. I think a lot of that is left from when they took over SAB Miller, which was several years ago now, but it was about a £70 billion acquisition, I think. So it did load them up with debt.
Should we move on to BP?
Yes. How are they doing?
So BP have come out with their Q1 results, and first quarter revenue fell 13% to $48.9 billion, and underlying profit fell from $9.2 billion to $6 billion. There were declines in all divisions, driven by lower oil and gas prices, a power outage at the Whiting refinery in Indiana, and lower margins on the sale of fuel products. Free cash flow fell from $4 billion to $700 million, reflecting lower profits, but also increased investment in the business. Net debt rose 13% to $24 billion. In the second quarter, the group expects a slight decrease in oil production. Margins on fuel prices will remain highly sensitive to input costs. Refining margins are expected to stay under pressure from market dynamics, but also maintenance activity. BP declared a quarterly dividend of 7.2 cents and announced a 1.75 billion share buyback in line with the first half target of 3.5 billion. And the shares were flat following the announcement. In terms of the valuation, the business trades at a forward PE of 7.4, and that compares to a 10-year average of 12.1. Prospective yield for the next 12 months is 4.8, and that compares to a 10-year average of 6. I don't think there's much surprising in this quarter. I don't think it's a terrible business. I don't think the debt's particularly concerning. I mean, if the free cash flow goes back up to where it was, the debt's not particularly concerning. But it's just going to rise and fall with the oil price, which is my main issue with it. I just don't find it a very attractive business. It's pretty cheap at the moment, and the dividend's pretty decent, so I can see why someone maybe would be attracted to it. Especially when that yield of 4.8% doesn't include the buybacks. But yeah, it's just not for me. John, what do you think as a former Shell shareholder?
I mean, I don't think they're terrible results. Obviously, it is the definition of cyclical. I suppose one of the difficulties is there is more political interference in the UK, and people don't really have any sympathy for the oil companies. Shell and BP obviously being the biggest two here in the UK. I suppose one thing that you might look at from a valuation point of view is, that they are significantly cheaper to their US peers. But I think for the political reasons, I would probably be staying away. However, when you look at it globally, and I suppose all of the uncertainty that's going on in the Middle East and growing demand for oil, there are quite a few things that are attractive about both Shell and BP. I wouldn't personally be going near it for the political reasons, but I think you could do a lot worse. And if you were to take that view on the geopolitical situation and you were holding it for a long time, even though it's an industry in structural decline, I think you could make a decent amount of money. I had BG shares, ended up with Shell shares, and I held them probably from about 2015, 2016, around that time, and they were some of the best shares that I'd ever had in my portfolio. They churned out a huge amount of cash, and yes, the share price was up and down, and it went very low during COVID, but then I sold it for significantly more than I bought it for, and I'd had that juicy dividend yield throughout. So I think it does show you can do well in these shares.
Should we move on to another business that's been a beneficiary of the current geopolitical climate?
Yeah, so it's one we've covered a few times on the show. It's BAE Systems, which is a defense company, makes a lot of jets, cybersecurity technology, warships. It's in fact, it's the biggest defense company here in the UK. And they had a trading statement alongside their AGM, with BAE Systems' full year guidance remaining unchanged, with sales forecast to grow between 10 and 12% from its 2023 base of £25.3 billion. And underlying profit growth is expected to outpace this, moving up between 11 and 13% from a base of £2.7 billion. And the Group's chief executive, Charles Woodburn, came out and said that global presence and diverse portfolio of products and services provide high visibility for top-line growth, margin expansion, and cash generation in coming years. And also to mention, the integration of the recently acquired Ball Aerospace is currently underway and has been renamed to Space and Mission Systems. And the business had a good start to the year, securing a number of key contracts. And alongside all of this, there is a 3-year share buyback programme of up to £1.5 billion, which commenced in July 2022, which is now over 90% complete. The shares were broadly flat following this trading statement. In terms of valuation, they have a market cap of £41 billion and they trade at 19.6 times forward earnings with a prospective yield of 2.4%. So since we've been covering it, I think this is the most expensive we've seen it. I mean, you are seeing the results improve significantly with the geopolitical situation and I suppose the visibility, as they mention, with all states, well, I don't know about all, but a lot of major players stating that they're going to increase their defence spending as a proportion of GDP, and BAE Systems was going to be one of the major beneficiaries of this. So I suppose that is why it is trading at the premium currently. It probably wouldn't be one for me, although I did take a look at it quite a few years ago. It must have been like 5 or 6 years ago, and I thought it was interesting. In some ways, it was defensive in its very nature, but it was carrying a lot of debt. It's looking like a much healthier business now, and I suppose with the events that have happened, you are seeing a turnaround in its fortunes. But yeah, I don't think it would be an industry that I'd be particularly interested in. Sam, what are your thoughts on BAE Systems and this trading statement?
Similar to you, it's not an industry I would be interested in either. What I find bizarre about it, though, and it's the management have done very well. Like you say, when we first started covering it, there was a lot more debt. They had problems with the pension. They had all kinds of issues. And you're not really seeing that now. I think the turnaround, I think management have done a very good job. And I suppose that's maybe reflected in the 10-year average, but I just think it's clearly a cyclical business. We're talking about GDP rising for countries, defence spending as a proportion of GDP rising for countries. At some point that will start to go down. It will ebb and flow depending on what's happening geopolitically. Everyone knows this. I don't think there's really any argument that BAE is a cyclical business. What we normally see with cyclical businesses is as they get to the top of the cycle, the valuation, the multiple comes down to reflect the fact that they're near the top of the cycle. BAE Systems hasn't done that. The valuations continue to go up along with earnings. So it's now the most expensive we've ever seen it. You could maybe make an argument that 10-year average is less relevant than it might be for, say, a house builder because of the issues that they've had to deal with in the last 10 years. But even still, I just don't know why you'd pay 20 times earnings for this business when it is cyclical. I just think it's probably management are doing very well, but even if I was interested in the industry, I'm not sure I'd want to pay up for it at the current levels.
No, fair enough. And I suppose one of the things you might say, it's got the moat on it. You can't have anybody coming into the defence industry. So I suppose it's got some, the barriers to entry are very high.
Yeah, I think there's reason you can make an argument for it, and the results are a lot better than they were 3 or 4 years ago. So it's understandable that would be reflected in the valuation, but I still think it's a bit pricey. Should we move on to a cheaper business?
Oh, yes, please.
So it's a favourite of the show. It's in the fancy portfolio, and it's a business we both own personally. Airtel Africa have come out with their full year results. And the total customer base grew by 9% to 152.7 million. And that included a 17.8% increase in data customers to 64.4 million and a 20.8% increase in data usage per customer. Mobile money subscriber growth was 20.7%. Transactional value increase was 38.2% in constant currency, with annual transaction value of over 112 billion in reported currency. Average revenue per user growth was 8.6%, and 95% of sites are now 4G operational, which is a 42.3% increase in 4G customers over the year. Revenue in constant currency grew by 20.9%, with growth accelerating to 23.1% in the final quarter. Nigerian constant currency revenue growth accelerated to 34% despite the challenging backdrop. Reported currency revenues declined by 5.3%, reflecting the impact of currency devaluation, particularly in Nigeria, which we've covered multiple times in the quarterly results. Mobile services revenue grew by 19.4%, driven by voice revenue growth of 11.9% and data revenue growth of 29.2%. Mobile money revenue grew by 32.8% in constant currency, reflecting continued strong performance in East Africa. EBITDA margins remained resilient at 48.8%, despite the currency headwinds and inflationary pressures on the cost base. Constant currency EBITDA increased 21.3%, with reported currency EBITDA declining 5.7%. Loss after tax was 89 million, and that was primarily due to foreign exchange headwinds, resulting in a 549 million exceptional loss net of tax following the Nigerian naira devaluation in June and the final quarter, and the Malawian kwacha devaluation in November 23. Earnings per share was negative at 4.4 cents compared to positive 17.7 cents a year ago. Earnings per share before exceptional items was 10.1 cents, which was a decline of 25.9%. In terms of valuation, because the earnings were negative, there's now no longer a PE ratio. If we were to take previous year's earnings, in fact, probably not do the previous years, I think we're probably better doing the earnings per share before exceptional items was 10.1 cents. So that would give it a PE of about 12. I think these results are fine. We've covered it throughout the year, so there's no surprises in there for us. We knew the issues they were having in Nigeria. Hopefully that won't be repeated, although it's already happened twice. So maybe that's a bit optimistic. I think that is the risk that you're taking with this business. That's partly why the valuation is so cheap, because it's in these markets. However, in constant currency, the results are excellent. I think operationally, the results are excellent and they've done a really good job. They cannot control the currency. That is just a risk you are taking as an investor. So I'm very happy with it. Hopefully, we won't see another year like we've had in Nigeria. Hopefully, the constant currency results can continue and translate to reported currency results next year. So I'm very happy with it. John, what about you?
Yeah, no, I would agree with you. It wasn't out of the blue. We knew what was we knew what was happening in terms of from a currency perspective. So yeah, it doesn't worry me too much. And I think even before we saw the massive devaluation of the naira, we had debated the valuation of the company and why, when it's as far as we'd covered it, it was continuing to put up excellent numbers. And it just reflects the markets it operates in. And this is something that can happen. Hopefully, things in Nigeria will settle and Airtel will continue to grow. But I think the long-term prospects, it's in a growth market. And, Nigeria, where it's major market, is the most populous state in Africa. I think there's an awful lot going for it, particularly when it comes to data and also when it comes to the money side of the business. So yeah, it's not worrying me too much.
Right, shall we move on to JD Wetherspoon then?
Yeah, so covered JD Wetherspoon lots of times, UK's largest pub chain. They had their Q3 trading statement out last week, with the group growing like-for-like sales by 5.2% in the third quarter, with growth rates held back by the timing of public holidays. The group now trades from an estate of 809 pubs, down from 814 at the end of January, and 17 of these are on the market or under offer. Net debt, as of the 28th of April, was £685 million, down from £694 million at the half-year mark. And the group expects full-year profits to be at the top end of expectations, which at a pre-tax level currently sit at between £67 and £75 million. And the shares were up 3% on the statement. In terms of valuation, JD Wetherspoon has a market cap of £995 million and trades at 15 times forward earnings, and it doesn't currently pay a dividend. I thought these results were pretty good. I think given the sector that it operates in, they're incredibly good. But for me, I think what would stop me when it goes looking further down, obviously it's got a lot of debt, and I know we've debated it before that it owns, in terms of its ownership of the freeholds of a lot of the estate, it's very high. However, I just think it's such a difficult industry to work in. I think they have a great product and great price points, but to make money in this industry is so, so tough. And I don't see it getting any easier. And you've seen the sort of saturation of JD Wetherspoon across the country, and they have done very well historically, but the sector is just one I'd stay well clear of. Sam, what are your thoughts on this trading statement and JD Wetherspoons, and I suppose the pub sector more widely?
I thought the statement's decent. I thought the revenue growth was pretty decent, considering that they've made such an effort, which they've not really gone into these results, but we've covered before, but they've made a real effort to not raise prices at all where possible. I think they've done very well with that. I wouldn't be too concerned about the debt just because there's so much equity in the properties that they own. However, I think if you're buying this business, there is nothing to indicate that they're going to release that equity. So although you're getting more than the earnings every year, I don't think for me that would be worth paying much of a premium for, because you've got no control over when it's going to be released. And unless they were to stop trading as a pub chain, which I don't think they're going to do, it may never be released. So it gives you more security that they're probably not going to, go under if the debt gets too large, because they can just sell off some properties or maybe lease them back. But I just think that equity is not going to be released. So for me, I wouldn't want it reflected in the valuation. Given that, I think a PE of 15 for a business that's incredibly saturated in a very tough industry is quite expensive. If I had to buy a company in the industry, I probably would go with JD Wetherspoons, but unfortunately, I don't have to buy a company in the industry, so I just wouldn't touch it. But that's not Spoon's fault. I think operationally they've been doing a good job for a while. I think the CEO's done a pretty good job. I know he's quite outspoken, but I do like him. I think he does do a good job. It is just an industry problem for me.
Fair enough. Shall we go on to perhaps our favourite company?
Yes, so another member of the fantasy portfolio and a business that we both own, Disney, have come out with their Q2 results, and revenue moved 1% higher to $22.1 billion, in line with market expectations. Higher ticket prices helped its experiences division, which includes its theme parks and cruises, to grow revenue by 10%. This was largely offset by a 5% drop in entertainment due to declines in traditional linear networks and content sales, which outweighed growth in direct consumer entertainment. Operating income grew 17% to $3.8 billion as the group continues to benefit from last year's cost-cutting initiatives. Free cash flow was up 21% to $2.4 billion, and net debt increased from $32.2 to $39 billion. Full year earnings per share guidance has been raised from at least 20% to 25%. The group completed $1 billion of share buybacks in the period, and the shares fell 4.8% in pre-market trading. If we go down a little further, the direct consumer revenue, that was up 13% to $5.642 billion, and that swung from a $587 million operating loss in the quarter last year to a $47 million operating income. So that's now actually operating income positive. In terms of subscribers, Disney Plus domestic, which is US and Canada, that's up 17% to 54 million. International is up down 2%, 63.6 million. Disney Plus core is up 6% to 117 million. So that's overall. And Disney Plus Hotstar is down 6% to 36 million. I think that's very good in that the more expensive markets are the ones that have gained, and the ones where they've lost, that's on, the much, much cheaper markets, the much lower the markets where they're charging a lot less. And they've gained it on the price increases. So they're losing the customers that they're losing money on, basically. So I've got no issue with those drops, and they've kept the customers in the core markets, which I think is the main thing. You'll see it when we look at the Netflix numbers every quarter, and you just look at the revenue coming from the US subscribers compared to, say, India or somewhere, and it's very obvious which one you want to be growing. So in terms of valuation, the business trades at a forward PE of 22, and that compares to a 10-year average of 23. The prospective yield over the next 12 months is 0.8%, and that compares to a 10-year average of 1.1. I think this quarter was okay. I'm happy with the direct consumer, which is probably the main thing I focus on. I don't really have an issue with the decline in linear. That's something we know is a business in decline. My main complaint would be that they're taking on additional debt and they're raising the dividend and buying back more shares. I would rather the net debt carried on coming down. I know some of it's going to be working capital, so I think it might swing back the other way. But overall, I want to see the debt reducing because they did take on a lot of debt to buy 20th Century Fox. And I think that was fine when interest rates were 1%, but I'd probably rather see them start to shift it now. What about you, John?
I would largely agree with that, Sam. I think okay, and I suppose good in parts, but I think some of those decisions may be a little bit more questionable. So I don't know. I like it a lot, and it's a company that it's very high quality and you don't lose any sleep over. I suppose it is expensive, but then again, you don't come across a quality company like Disney without paying up for it. So I think we'll see, but I would hope that it could get back to some of that higher growth.
Yeah, but I think as well, direct to consumer, that's still growing. I mean, it's only contributed 49 million out of 3.8 billion of operating income. So that's still got a long way to grow.
Yeah.
So I think when you factor that in, I don't think the valuation is ridiculous. I just think some of the decisions are maybe slightly short term at the minute. But,
yeah.
Because it's like last year, Bob Iger's come back in. He's brought in the cost cutting initiatives, which seem to have done a good job. I'd suggest there was quite a bit of bloat. And then what's he use the extra cash for? He's just increasing buybacks.
Yeah.
But I just think when you've got a debt pile that big, I just don't get it. But it is the norm, unfortunately, with these businesses.
Yeah. So, Sam, of the companies this week, what would be your top pick and what would come last?
So I think top pick would probably be Disney. It's a bit of a tougher one because you've got Disney and Airtel Africa in the same week. But I just think with the issues Airtel Africa has had, although I like it and I think it's very cheap, I think it would come down to what you said. You don't really need to worry about Disney as much. Whereas Airtel Africa, you've got to keep an eye on it, although that's reflected in the valuation. So that I think Disney would be my favourite. Least favourite, that's quite a tough one, actually. I think for me, probably ABInbev, actually. I'm not a huge... Partly I don't like the product, but I just think it's quite expensive. I don't think the growth's that good. Yeah, I think it's probably on valuation, but it's not a terrible business and the results weren't terrible, but it's just not for me. There's a few businesses in here that aren't for me, but there's probably out of ABInbev, BP, BAE and Spoons, I would violently be opposed to getting any of them. So it was a toss-up that. What about you?
So last would be JD Wetherspoons. I just think it's the sector. I just couldn't. Yeah, I wouldn't want to be invested in it. And then top of the list, it would be between Disney and Airtel Africa. It's very difficult with Airtel Africa in currency situations at the moment, and whether it's discounted enough. I think when the Naira originally devalued significantly, it probably was reflected more in the price, whereas the shares actually in Airtel Africa have recovered a lot since then. So I don't know. Probably go for Disney and play it on the safe side, but I do have both Disney and Airtel in my portfolio and quite comfortably too.
I think that's everything in that case.
Thank you again for listening, and we'll see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.